so that AI training costs are dropping 75% per year. AI inference costs are dropping 85 to, if you believe DeepSeek, 98% per year. Astonishing declines. And we think that this measure of the yield curve, in its wisdom, is onto that. We shall see if the Fed continues to ease and this measure of the yield curve does not surpass where it was in COVID, right after COVID, then this downtrend will be in place and our conviction in what I just said will increase significantly.
Hey guys, welcome to Everyday Finance. The surge in Bitcoin above $112,500 has sparked excitement once again, but with caution. According to CryptoQuant's on-kind data, the net unrealized profit-loss indicator is at plus 0.52, which historically denotes a transition from optimism to euphoria and frequently occurs prior to significant cycle tops like those in 2017 and 2021. Strong investor confidence is demonstrated by the fact that about 97% of Bitcoin's circulating supply is currently profitable. Nonetheless, cooling episodes may be preceded by this same confidence. Since short-term holders, those who have held for fewer than 155 days now, account for roughly 44% of Bitcoin's realized cap. Newcomers are progressively controlling supply, while long-term holders start to profit. When speculative momentum peaks, this behavior frequently signals the bull cycle's final extension. However, increased stablecoin liquidity, ETF participation, and institutional inflows might all help mitigate any market declines. The short-term holder cost base, or $112,500, is the crucial amount to keep an eye on. Maintaining above it encourages further upward movement, but dropping below it can portend a more extensive decline in the future.
And you can see here another indication that inflation is not being pushed up much, if at all, by tariffs. And as we digest the tariffs, we think the resolution here in terms of this recent basing of inflation is going to be to the downside and towards that 0% mark. Now, one of the things that we're really focused on, as we've been discussing for actually a long time now, is the velocity of money. And we've been expecting, with all of the uncertainties, tariffs and so forth, that people would become fearful and pull in their horns from a spending point of view. And they are beginning to do that. That usually means the velocity of money falls. So the velocity of money is in the green line here. And we have mapped it against the participation rate, the labor force participation rate. It's the only metric that I have seen that correlates with the behavior of velocity since it peaked in 1997. So we've been expecting with the tariffs and employment disappointments, we've been expecting the consumer to become more conservative in spending. So the velocity of money in that case would roll back over and start falling. Well, it has flatlined. It hasn't quite done what we thought, but it is no longer going up. In other words, it's not turbocharging that money growth. That 5% year over year growth in money, if velocity is flat, means nominal GDP will be roughly 5%. If money growth slows down here, or if velocity rolls over, then nominal GDP growth will be below 5%. So let's see what happens. So far, we're in a bit of a balancing act. We didn't expect that. That's what's happening. And I'll go into why in a moment. In fact, in a very short while. Here, though, is a measure of the yield curve, so longer-term rates minus shorter-term rates, in this case the 2-year Treasury yield minus the 3-month Treasury yield. And when it's below zero, that means that monetary policy is typically erring on the tight side. The Fed is too tight, too restrictive. And you can see in the past, when it has reached this kind of level, we have typically been close to, if not entering, a recession, as shown in the shaded area there. We haven't had a recession, but as you know, we've been calling the last 3 years a rolling recession, which is consistent with where this measure of the yield curve is. This measure of the yield curve suggests that the Fed should continue to cut rates 1, 2, 3 more times. But if we're right, next year the Fed will stop cutting rates if we're right on the productivity-driven boom in activity. For right now, though, this metric suggests the Fed should continue to cut rates. Now, this is another measure of the yield curve, and I am watching this quite carefully because of what we noticed in COVID. We noticed that despite the fact that governments around the world, from a monetary point of view and from a fiscal policy point of view, we're just throwing money at a problem that, seemed likely to throw the global economy into a depression. They certainly averted that. But there was so much stimulus, I would have expected this measure of the yield curve and the steepness of it to move into where it was in the 08-09 period. It did not. What does that suggest? One of our hypotheses is that the bond market, in its wisdom, does see the deflationary undercurrents that are at work in the economy today, a lot of them because of technologies. And I haven't done this in quite some time, but to give you a sense of the deflationary drama, this is good deflation. When you cut the price of a technology, it will increase in terms of unit growth. But to give you a sense of the deflationary drama out there, for every cumulative doubling in the number of industrial robots produced, costs will decline by 50%. That's called Wright's Law, and we've centered our research around it. In the electric drivetrain space, that's the largest expense in an EV. For every cumulative doubling in the number of those produced, costs decline by 28%. DNA sequencing, for every cumulative doubling in the number of whole human genomes sequenced, costs decline by 40%. And AI, for every cumulative doubling in a metric that we have devised, it's a metric involving data per unit of computing power. For every cumulative doubling in that, costs, both hardware and software, drop by 48%. But the astonishing thing is those costs, that cost decline is happening in less than a year's time. The cumulative doubling is happening in less than a year's time, so that AI training costs are dropping 75% per year. AI inference costs are dropping 85 to, if you believe DeepSeek, 98% per year. Astonishing declines. And we think that this measure of the yield curve, in its wisdom, is onto that. We shall see if the Fed continues to ease and this measure of the yield curve does not surpass where it was in COVID, right after COVID, then this downtrend will be in place, and our conviction in what I just said will increase significantly.
Dollar cost averaging, or DCA. is still one of the most dependable and useful tactics for cryptocurrency investors in times of market volatility. It entails investing a certain sum at regular periods, independent of price, as opposed to timing the market. This strategy balances purchases made during market highs and lows, reducing volatility over time. A weekly purchase of $10 worth of Bitcoin, for instance, would result in a steady average entry price, as you would be acquiring more during declines and less during surges. DCA promotes resilience, emotional control, consistent growth in the face of erratic short-term price swings.
On this page, you can see, again, real GDP and how importantly productivity influences it. Now, productivity in this rolling recession is still in the 2 to 2.5% range on a year-over-year basis. That is very good. What has kept real GDP growth up until recently has been government spending and spending in government-related sectors, education and healthcare, importantly, among them. We're losing a lot of those growth vectors to changes in policy, of course, and the other variable holding this GDP growth rate up, and GDP is in the purple here, has been really the high-end consumer. Almost every other sector has been under duress, with the exception of capital spending associated with artificial intelligence, so data centers and power sources and so forth. So that's what's kept GDP up. If we're right, GDP growth could slow a bit more, but will turn around, and we will enter into a real growth trajectory driven by productivity in the 5% range. And we believe that in that range, 5% plus or minus, that unlike in past recoveries, it will be sustained. You can see in the past, when productivity has recovered, usually after a recession, it settles back down. This time, we don't think that's going to be the case. So stay tuned for that. On the next page, you can see where we are right now in terms of manufacturing and non-manufacturing activity. So non-manufacturing is in green, manufacturing in purple. And you can see manufacturing activity has been negative for roughly 3 years. That's what we mean by the rolling recession. And even non-manufacturing is beginning to suffer. It just dropped, I believe, to roughly 50% in the latest reading. And I think that was a September reading. So we're not really seeing a lot of growth from these two areas right now. You can see on the next chart that, and this is a very new report, it just came out today. Here you can see the ISM for services, so non-manufacturing, but a broader take at it, dropped back to 50. And I should have explained, 50 is the demarcation point between expansion and contraction. So ISM for services, the new orders, which is in green, slipped back to 50, meaning there's really no growth. You can see prices paid around that 70 mark. So those prices are still going up. But notice what I just said. Activity down, prices up. Companies try and make up for weak activity with pricing, especially as they're facing tariffs. And a lot of the manufacturers who report in this survey mentioned tariffs, that the tariff cost increases have intensified, and they're trying to get those costs passed through into pricing. And we'll see if they are successful. One of the reasons orders have relapsed, we believe, is because they are trying to get prices through. And the consumers of these products are basically saying, no, you'll have to cut your prices. So again, stay tuned on that one. And it's important because this is the services sector. Now here you can see we're going into employment. While we didn't have a report today, we want to lend some perspective to what's going on out there in employment. So in the green is the monthly unemployment rate. Now, it is being held down, we believe, by baby boomers retiring, about 1.3 million per year, and immigrants leaving because of our government policies. And then longer term, it's low fertility rates. What you see in the purple is the unemployment rate for recent grads. And you can see in this rolling recession, that unemployment rate has gone up from roughly 5 to 6.5%. And it's going up for a couple of reasons. One is cyclical, as I just mentioned, but the other is because of technology. AI in particular is starting to limit the increase in entry-level jobs. We don't need as many new research associates as we might have needed, given that we've started up new products and so forth, because we are automating. We're using Palantir, and we're all vibe coding. I'm not going to tell you I'm doing a lot of vibe coding myself, but I've dabbled with Replit, and it's really empowering if you have the time to do it.
A practical illustration of controlled accumulation can be seen in El Salvador. The nation has been purchasing 1 Bitcoin every day since November 2022. Transparent and automatic scheme that has expanded to national holdings valued at hundreds of millions of dollars. This tactic shows how little regular activities can add up to a lot of benefit over time. However, DCA is not perfect. In periods of robust bull markets, lump sum investments may perform better. Making modest purchases frequently could raise trading expenses. Nonetheless, DCA's framework provides stability, psychological equilibrium, and a clear route to long-term growth for the majority of investors who make a consistent income. It transforms the unpredictability of cryptocurrency into a planned path to financial stability.